Imagine you've just survived a brutal year in the markets. Your account is down, but you lived to trade another day. Then you open your mail and find a tax bill from the government for thousands of euros. In the Netherlands, the Belastingdienst doesn't care if you made a 50% return or a 10% loss. They ignore your actual P&L completely. Instead of looking at your daily trades, the Dutch government views you as a wealth entity. They tax the raw size of your capital, not your trading performance. To survive here, you have to throw out everything you know about standard capital gains. You need a strategy that specifically navigates the infamous Box 3 tax code while operating strictly under the watchful eye of local regulators. The government assumes your trading capital automatically earns a fixed profit. Even with heavy losses, you're taxed on this massive assumed profit. You get a tax-free safe harbor of roughly 57,000 euros. Once your capital crosses that line, the excess is flagged as taxable other assets. On January 1st, they apply an assumed 6% return to that excess. Your tax bill is based entirely on that imaginary chunk. This creates a constant wealth leak. If you leave your money in your account to compound, your tax liability grows every single year, regardless of whether you place a single winning trade. Churning the market with high-frequency, low-yield trades will bleed you dry here. You have to hunt for high-probability setups that generate returns large enough to completely eclipse the government's assumed yield. That need for high-probability trading aligns perfectly with the operational environment built by the Autoriteit Financiële Markten, or AFM. They enforce strict leverage ceilings. Retail traders are hard-capped at 30-to-1 for major currency pairs and 20-to-1 for miners and gold. This graphic compares an offshore 500-to-1 leverage account with the AFM 30-to-1 standard. A tiny market dip wipes out the over-leveraged account, while the regulated account easily absorbs the exact same noise. These caps are a mandatory safeguard. They force you to keep enough breathing room to survive natural volatility and protect your base capital. The AFM also mandates negative balance protection. It acts as a legal insurance policy against extreme, unpredictable market gaps known as black swans. When the Swiss National Bank removed their currency peg in 2015, prices gapped violently, leaving unregulated traders with massive debts. But under AFM rules, your losses are strictly capped at your account balance. To maintain this protected environment, the regulator also heavily restricts marketing. You will never see a legal Dutch broker offering a deposit bonus or a cash rebate. Those free money perks usually come tied to massive volume requirements. They are predatory traps designed to make you overtrade until your capital is completely depleted. Stripping away those gimmicks forces brokers to compete on the metrics that actually matter: lightning-fast execution and the tightest possible spreads. The Netherlands has actively engineered a market that filters out the gamblers. It rewards a strictly disciplined, calculated approach to the markets. You operate in a dual reality. The AFM shields you from catastrophic debt, while the Box 3 tax system aggressively taxes your capital ambition. You need to audit your broker's regulatory status immediately and adjust your compounding strategy so your actual returns easily outpace the state's notional yield. That level of precision requires a platform like FXNX. Operating fully regulated under international safety standards, it offers 0.0 pip spreads built for professionals. Thriving in the Dutch market is entirely possible. Equip yourself with institutional-grade technology and focus purely on the mechanics of your next trade.